about the tightness in the banking system. A lot of commentary being written about, oh, loans are growing faster than deposits. And of course, the loan to deposit ratio that you see on the left hand side. And this is, remember, this is almost like a 20 plus year chart. Without doubt, the loan to deposit ratio is elevated in the current environment. But to be very clear, this has nothing to do with Indians choosing to invest more in mutual funds or for that matter in equities, because even if they invest over there, that money stays within the banking system. They may be buying equities, but somebody is selling equities and therefore money stays in the banking system. And all trades that you do in the market are eventually settled within the banking system. So really, more people investing in financial assets other than bank deposits has no impact on bank deposits, except the nature of bank deposits and liquidity might change because people move more towards or because the liquidity in the banking system would then be held in current accounts rather than being held in term deposits. So that's the only impact which happens when more money moves towards non-financial assets, excluding bank deposits, but it doesn't really impact deposits directly. The biggest contributor to the tightness is actually RBI directed, because RBI created money. Now, M3, without getting into jargon, is the widest definition that we have of money supply. Who is a very significant contributor to money supply? It is the RBI. In times, they have accounted for as much as 22-23% of total money supply is the money created by RBI. Currently, they are running well below trend. They are running at just about 18% of total M3 being contributed by RBI created money. And remember, this RBI created money is a reflection also of RBI's own thought process, which is withdrawal of accommodation. So in a way, we think these two are actually linked, and therefore some of the tightness that you see in the banking system reflects RBI's conscious choices, maybe driven by the inflation targeting methodology that they have, but they are keeping liquidity tight. And we do believe that as they start to see growth come under pressure, or for that matter, they see inflation well within the comfort zone, they will start to think differently about the liquidity that they are creating. And this should help the system liquidity start to balance itself much better. So that's sort of the...
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.